The way charitable giving is taxed changed this year, and if you give faithfully to your church every month, that changed at almost zero for you. You give regularly, and our tax code allows you to deduct charitable gifts. So why are you getting the same deduction as folks that give little or nothing? How can you make sure you're getting the biggest deduction possible without changing the amount of money you're giving each month or year to your church? Well, if you have a money question or worry, the answer is probably give more. I'm Jason Demland. Welcome to Give More. There's much to be grateful for in the United States of America, and one of those things is our tax code. It encourages giving. In 2026, a married couple, both 65 plus, gets a $35,500 standard deduction right off the bat without giving anything. If they give to a charity, they get an additional $2,000 on top of that. And there's also an additional new $6,000 per person senior deduction, but that doesn't have anything to do with giving. So it really doesn't make a difference if you give a lot or you give a little to your church. If you give $2,000 or you give $30,000 to your church, if you don't itemize, the deduction's the same. I think big standard deductions are great, but they can disincentivize charitable giving when you get the same deduction whether you give a lot or give a little. We've already talked a lot about how taxes shouldn't direct your giving, and that your church is the first place that you ought to give. But that doesn't mean we shouldn't look for opportunities to maximize tax benefits of our already planned giving. We should be looking for opportunities to give smarter. Take Hank and Peggy Hill here as an example, with some hypothetical and projected figures. Hank and Peggy Hill are just about to retire. Hank's working his final year at work. He makes $250,000 a year. They give $25,000 to their church every year, but you wouldn't know it from their tax return. They're getting a nice standard deduction according to this hypothetical example, and they only get to deduct an additional $2,000 because of their large annual gift to their church. Oh well, right? I don't think so. What if you could go ahead and pre-give, say, about 5 years worth of your annual tithe, continue to give to your church monthly, and deduct that whole 5 years worth of giving in a single tax year? A donor-advised fund is exactly the vehicle for this job. You can make one large gift into the fund of cash or even appreciated stock, claim that deduction now, and grant it to the church over time. The bonus is that money can stay invested and compound as well, and may very well grow to even more later. The catch is that the money is not yours anymore. You've given it away, and it must eventually go to a qualified charity. The good news is that sponsoring organizations of donor-advised funds are incentivized to make the grants that you recommend. And if they didn't, it's likely that folks would just stop using them, and they wouldn't get any more donor-advised funds to grant. I've successfully employed this strategy with clients, and it might work for you too. The reason to use a donor-advised fund is to get a tax deduction you otherwise would not have gotten. If you bunch several years' worth of giving into one large charitable gift to a donor-advised fund, then you've cleared the standard deduction, and you've cleared this new 0.5% of adjusted gross income floor for deducting charitable gifts all at once in 1 year, instead of having to do that each year. Yeah, there's a new 0.5% floor for charitable gift deductions that was included in the One Big Beautiful Bill Act. I'm not excited about it. And while it didn't change anything about donor-advised funds themselves, actually it leaves them out of the new $2,000 deduction for gifts to charity, it did make this bunching strategy more necessary. While the act added an additional $2,000 deduction for direct gifts to charity for folks taking the standard deduction, for itemizers, it added this 0.5% floor, which reduces the total amount that you can deduct if you itemize. The use case for this really depends on your income. If you have a high income year because you're still working, or because you're doing big Roth conversions, or maybe because you've sold a business, that's when this makes a lot of sense. Let's look at Hank and Peggy Hill's plan. Hank is in his last year of work before retirement and will make $250,000 this year from his job, and around $16,000 in additional interest, dividends, capital gains from their investment bank accounts. Hank's 66 years old, and Peggy is 64. So Hank gets the senior add-on to the senior deduction. Peggy's not old enough yet. If they continue as normal, they'll pay $40,262 in taxes. They'll use the standard deduction of $33,850 plus the $2,000 for their $25,000 church giving. Now, Hank and Peggy have saved well, and they have enough cash and after-tax investment money to pre-give a substantial amount to their church through the conduit of a donor-advised fund without taking money from their IRAs. Let's say they decide to donate 6 years worth of their annual giving. That works out to a $150,000 gift to their donor-advised fund, and, coincidentally, is 60% of their adjusted gross income, which is the maximum deductible amount for cash gifts in 2026. Then they instruct the donor-advised fund to grant $25,000 a year to their church for the next 5 years. I'm going to come back to this later. Now, their total deductions come out to $154,521 for the year, and their taxable income is reduced to $111,623 in 2026. That reduces their total federal tax from $40,262 to $13,959 in the year. That's a $26,303 difference in federal tax, which works out to a little more than 1 year's worth of giving to their church. Note that AGI is the same in both scenarios. The donor advised fund just reduces taxable income. The plan doesn't break. The pushback against this is parting with all that cash right up front. People will ask, won't this break my plan or cause us to run out of money faster or add risk? Well, that's definitely something to check out and why a plan is really important. Luke 14:28 encourages us to count the cost. We ought to be wise, but don't be afraid. Remember, fear says you can't part with all that money right away, but what if the plan says you can? Fear overpays on taxes and gives little. Look at Hank and Peggy's plan. We're comparing apples to apples here, and the only difference is a large gift to a donor-advised fund and replacing giving for a few years with grants from the donor-advised fund instead of from their savings. And later, when Hank is 71 years old, switching to qualified charitable distributions. The donor-advised fund proposed plan actually turns out slightly better in the long run. Now, we don't exactly know what will happen in your life, and that's why planning is ongoing forever and ever, and this Monte Carlo analysis is just a projection. But the amount given to your church is the same in each of these scenarios. It's just that in our proposed scenario, you get to pay less in taxes. Now, does it add some complication? Yes. Does it commit you to the giving? Oh, yes. And that's a feature, though. That's not a bug. And there's nothing stopping you from giving extra directly to your church or other ministries while this plan is executed. In our hypothetical, the Hills gave cash to the donor-advised fund. But the same strategy can have an even bigger impact depending on the assets you have. Next time, we're going to talk about gifts of appreciated securities. Now, gifts of appreciated securities like stock to a donor-advised fund are capped at 30% of AGI compared to 60% for gifts of cash. So it takes some math there. Right-sizing your gift to the donor-advised fund is about how much you're already giving. It's about how much you'd like to give, and about what the tax benefits associated with it are. Sometimes a mix of cash and appreciated securities makes the most sense in your giving. And pairing a large charitable gift with Roth conversions can really supercharge your retirement tax plan, and that's a whole nother future show I'm excited to get to. If what you're giving is simple and steady and your income is fixed and low, then a donor-advised fund could very well be just adding complications without any benefit. If you don't have the cash or securities available to donate, this isn't going to do much for you, especially with the standard deduction getting so high, and especially for those who are 65 plus. There's simply no tax benefit to doing this unless the bunched gift is large enough to push you over the standard deduction and into itemizing. Getting a deduction is not a reason to give, but active tax planning can help you give more. Over the Hills plan, the proposed strategy projection results in more assets at the end of their lives, and it sends more to their church than the current one in the end. Remember the 6th year of giving that stayed in the donor-advised fund? In this hypothetical, the assets are invested, and the leftover balance of around $50,000 after their regular church giving grew and compounded into a large balance over the next 30 years of their lives. And the projection shows that is about $630,000 still in the donor-advised fund when they die, all of it eventually ending up at a charity. That's extra money to give while you're alive, or when you die, or for you to leave in the donor-advised fund for a successor advisor to request grants to charities from after you're gone. You can check to see if this may work for you. Are you itemizing or are you taking the standard deduction? Are you planning to continue giving to your church through your lifetime? Through your retirement? You can go ahead and calculate what 5 to 10 years worth of gifts to your church works out to. And what if you gave it all in 1 year to a donor-advised fund and you let the donor-advised fund give monthly grants to your church? These are some thoughts to take to your tax professional and to think through as you work on your retirement plan. It may mean extra tax savings with the same level of giving. If you're hesitant to commit to the gift, remember why you're giving in the first place. Give cheerfully, give with joy, Soli Deo Gloria.